Every second, money moves across borders. A manufacturer pays a supplier. An investor purchases foreign assets. A company pays employees overseas. A family sends money home. From the outside, it appears simple. One bank sends money, another bank receives it. But that is not how the modern financial system actually works. Most international payments are not physical transfers of cash. They are coordinated changes to financial records, messages, instructions, confirmations, settlements, and reconciliations. The transaction is less like shipping a package and more like synchronizing thousands of independent ledgers. Every institution must trust the information it receives. Every instruction must follow common standards. Every participant must understand the same language. Without that shared language, global finance would become fragmented. Banks would struggle to communicate. Payments would slow dramatically. Trade would become more expensive, and uncertainty would increase across the economy. The hidden infrastructure behind global finance is therefore not only money, it is communication, protocols, standards, and trust. The world economy runs on financial messages, and behind every message, there is code.
Imagine thousands of banks, operating in different countries, speaking different languages, following different regulations, using different software. Now imagine trying to coordinate millions of transactions every day. The challenge is enormous, not because banks cannot move money, but because they must understand one another. Every payment instruction needs structure. Who is sending? Who is receiving? Which currency? What amount? Which account? What purpose? What compliance requirements apply? Without standardized formats, every institution would interpret information differently. Automation would become difficult. Errors would increase. Fraud detection would weaken. This is why financial messaging standards became essential. They create a common language, not for people, but for financial systems. Software can process the information consistently. Banks can automate workflows. Compliance systems can evaluate transactions. Settlement systems can coordinate obligations. The protocol does not replace trust. It organizes it. The more institutions adopt common standards, the more efficiently global finance can operate. The language itself becomes infrastructure, invisible, yet indispensable.
One of the biggest misconceptions about international finance is assuming that sending a payment message automatically transfers the money. In reality, messaging and settlement are different functions. A payment message communicates intent. It tells participating institutions what should happen. Settlement determines when obligations are actually completed. This distinction is fundamental. Information may move almost instantly. Liquidity may not. Different institutions must coordinate balances, verify available funds, manage risk, confirm compliance, and complete accounting records. Only then is the transaction considered fully settled. This layered architecture makes the system resilient. Communication remains standardized. Settlement remains carefully managed. Every layer performs a different responsibility. The message creates coordination. Settlement creates finality. Confusing the two leads to misunderstanding how global finance operates. The code tells institutions what to do. The settlement system determines when the financial obligation is complete. One moves information, the other completes value.
The world contains thousands of banks. Very few maintain direct relationships with every other institution. That would be impossible. Instead, banks rely on networks, relationships, correspondent accounts, and trusted intermediaries. These connections allow financial institutions to reach markets they do not directly serve. A regional bank may access international payments through larger banking partners. Those partners may maintain relationships across multiple jurisdictions. The network expands outward, not through universal direct connections, but through trusted pathways. This architecture dramatically reduces complexity. Instead of every institution connecting with every other institution, networks create efficient routes. But efficiency introduces dependency. Some institutions become highly connected. They process enormous transaction volumes. They provide liquidity. They coordinate relationships. And they become critical nodes inside the financial system. The visible payment may involve two customers. The invisible infrastructure may involve multiple financial institutions coordinating behind the scenes. Global finance resembles the internet, not because money moves like data, but because networks create scalable connectivity, and the most connected nodes often become the most strategically important.
Trust is often described as a human concept. In global finance, much of that trust has become computational. Identity must be verified, institutions must authenticate one another, transactions must be screened, sanctions must be checked, suspicious activity must be evaluated, records must be maintained. Compliance has become software. Risk management has become algorithms. Authentication has become cryptography. The larger the financial system becomes, the less it can rely exclusively on manual verification. Automation becomes necessary, not because humans disappear, but because scale demands assistance. Every payment passes through layers of validation. Some are regulatory, some are operational, some are technical. Together, they create confidence that participating institutions are following shared rules. Trust becomes architecture, not simply belief, but repeatable verification. The financial system depends on confidence, and confidence increasingly depends on digital infrastructure capable of validating millions of transactions every day.
Global payments involve complexity. Currencies differ, regulations differ, time zones differ, legal systems differ. Every additional step creates friction. Verification takes time, currency conversion introduces cost, compliance requires processing, settlement requires liquidity. Individually, each step may appear small. Collectively, they influence trillions of dollars in commerce. Reducing friction therefore creates enormous value. Faster settlement improves liquidity. Better automation reduces operational cost. Standardized protocols reduce errors. Improved interoperability increases efficiency. Modern financial innovation often focuses less on replacing the system and more on reducing unnecessary complexity inside it. The fastest network is not always the most valuable. The most valuable network may be the one that reduces uncertainty. Less uncertainty lowers cost. Lower cost encourages trade. More trade creates growth. This is why financial infrastructure matters, not because it is visible, but because every improvement compounds across the global economy.
Financial communication continues to evolve. Modern systems increasingly exchange richer information, more structured data, greater automation, improved interoperability. Instead of treating payments as isolated events, financial infrastructure increasingly treats them as connected business processes. Invoices, trade documentation, compliance, settlement, accounting, and reporting. Everything becomes more integrated. Structured information reduces ambiguity. Software can automate more decisions. Institutions spend less time correcting errors. Businesses gain greater visibility. Governments improve oversight. Innovation accelerates because the underlying language becomes more expressive. The evolution of financial standards rarely attracts headlines,
yet it quietly transforms global commerce. Just as internet protocols enable digital communication, financial protocols continue improving how value moves across institutions. The infrastructure evolves, and the economy evolves with it.
Digital assets, tokenized finance, programmable money. New technologies continue emerging. Yet one challenge remains remarkably consistent: coordination. Every financial system requires shared rules. Participants must agree on identities, ownership, finality, governance, security, and dispute resolution. Technology may change. Architecture remains essential. A faster asset still needs trusted infrastructure. A programmable transaction still requires validation. An automated financial system still depends on common protocols. Innovation does not eliminate coordination. It increases the importance of it. As finance becomes increasingly digital, the invisible layers beneath transactions become even more significant. The future may introduce new forms of money, but every form of money still requires systems capable of creating trust at scale.
Power is often associated with ownership, but systems reveal another form of influence: rule-making. A protocol defines how communication occurs. A standard defines how information is organized. An interface defines how systems connect. These decisions appear technical, yet they shape the behavior of entire industries. Once adopted at scale, standards become difficult to replace. Businesses adopt, software evolves, institutions invest, networks expand. Compatibility becomes valuable. Changing the underlying architecture becomes increasingly expensive. This is why infrastructure creates leverage, not because it forces participation, but because participation becomes efficient. The most influential systems are often those that others voluntarily build upon. When enough participants share the same language, the language itself becomes part of the economy: invisible, persistent, foundational.
Civilizations have always depended on infrastructure: roads, ports, railways, electricity, telecommunications. The digital economy added another layer: protocols, invisible rules coordinating billions of interactions every day. Global finance is built upon those invisible layers, not simply currencies, but communication, verification, coordination, settlement, and trust. Every international payment depends upon institutions understanding one another. Every financial relationship depends upon shared standards. Every improvement to the architecture creates compounding economic effects across the world. The greatest financial innovation is not always the newest application. Sometimes it is a better protocol, a clearer message, a faster settlement process, a more interoperable standard. Because infrastructure rarely competes for attention, it quietly enables everything built above it. The companies change, governments change, technologies evolve, currencies rise and fall. Yet the architecture connecting financial institutions continues to shape how global commerce functions.
The future of finance will undoubtedly introduce new technologies: artificial intelligence, programmable assets, digital currencies, autonomous financial agents. But regardless of how money evolves, communication will remain essential. Rules will remain essential. Trust will remain essential.
and the systems capable of coordinating billions of financial interactions will remain among the most valuable infrastructures ever created. Because in the modern economy, money is only part of the story. The real architecture of global finance is built from information, protocols, standards, and trust. The world may measure wealth in currencies, but wealth moves through systems, and whoever architects those systems architects the future of global commerce. Nick Serra, Decoding Systems, Architecting Wealth.